Welcome to the On Your Side podcast. I'm Gary Harper.
And I'm Susan Campbell.
You know, it's that time of year again, and I'm not talking Christmas.
No.
There's something else.
Something a little less fun than that.
Yeah, I mean, we all look forward to the holidays and, family and eating and drinking, and then, what comes next.
And then January hits.
Oh, my gosh. It's that time, yeah, and we're talking taxes. Have you tackled anything yet, Susan, with taxes?
No. But that's why we're doing this podcast, so
Yes.
I can prepare.
Yeah. I just give everything to my accountant, and I just say, take care of it. I'm not messing with it.
You and I are different. You have an accountant that handles it.
Yes.
I have always done the taxes myself for our family.
No way. Number one, I don't trust myself. And number two, I never get a refund. So I just don't want, I always have to pay, but I just don't want to pay more than what I, really have to pay.
But my taxes aren't that complicated. I normally do the standard deduction we're off to the races.
Mine get a little messy. Yeah. So
do you have secrets to tell?
Well,
our podcast guests?
Not on the podcast, but hey, listen, for more information and to get the biggest refund that you can or the smallest payment that you have to make to Uncle Sam, we're talking to Mark Steber. He's the Chief Tax Information Officer at Jackson Hewitt. Hey, how you doing today, Mark?
I'm doing wonderful. I can't wait to amend Susan's returns and get those all, back in compliance. So
help me.
We'll talk after the show about the man coming around. And
you are what we call a friend of On Your Side because you've been with us before. You're a wealth of information. You're greatly involved with educating folks on taxes, and we appreciate that. So let's just jump right into it. We're all getting ready for tax season as far as getting our paperwork together. And we've got to get everything, ready to either do it ourselves or send it to a professional. What are we looking at when it comes to any changes that we need to know about for this tax season?
Well, the answer is in two parts. The first is there were changes in 2024, even though you might hear on social media or in the news, it was a non-change year because of the election or what have you. And that's, first of all, not true. There were statutory changes and legislative changes, changes in rate brackets, changes in standard deduction and credit amounts. Now, those are kind of automatic, and any competent software, and we'll talk about that in a minute, should handle that pretty easily. But there were also some new rules in place, and a big one this year that's probably bigger than in most years past. There's a new reporting threshold on the Form 1099-K. Now, your viewers or listeners might not know what that is, but the 1099-K is simply the form that third-party payment platforms, think Apple Pay, PayPal, any of those things. If you get paid on that and have higher than a certain amount, and the amount before this year was $20,000 before you got a 1099. The new amount is $600, but they transitioned it in over a couple of 3 years. This is year one, and the threshold is $5,000 for this year, tax year 2024. So if you got Venmo money, PayPal money, Apple Pay money over $5,000 during 2024, for business or selling Taylor Swift tickets or NFL tickets or whatever the reason, you're going to get a 1099-K, and so is the IRS. So if you're considering this a hobby or part-time, or I don't really have to report that because Uncle Bob, my TikTok Uncle Pro, said I didn't, you're going to be in for a surprise. New threshold this year, $5,000. Tax year 2025, where we're sitting right now, it's $2,500, and in 26, it's $600. The point is simply this: if you have a side gig and you're getting paid more than $5,000, IRS now knows about that, or soon will on January 31st when those deadlines hit.
And otherwise, that is not just a one-time payment of $5,000. That's overall.
Whole year. Yep,
so
January 1st.
It could be a $200 payment here, a $500 payment here. It just has to add up to $5,000.
$5,000 per platform. So you may get multiple 1099-Ks if you're on 4 or 5 different platforms. Sold a car here, sold a sofa there. I'm doing some side hustle payment work over here. I drive part-time rideshare here. You could get 4 of those things. Some may be taxable, some may be not. Some may have a business element, some may have a personal gain element. You may have sold 2 Taylor Swift tickets and got it in one hit. But you're exactly correct. It's throughout the year, and it's for year 24 that it's the $5,000. Tax year 2025, where we're already kind of 3 weeks into, it's only $2,500, and you're only 11 months out from having it be a $600 threshold.
What if I'm the person? I'm sorry to jump in. What if I'm the person who always just puts down my credit card if I go out to dinner with my friends a lot and then they Venmo me to pay me back? I'm not actually making money off of that. how does the IRS know that that's not taxable income?
They don't. You're relying on the way you filled out your third-party platform information, the description, the third-party platform, and their algorithms to get all that right. And that's a lot of if on this first big year. Now, the good news to your audience is if it's just that, splitting a meal or sending your daughter at college gas money, it's not taxable. That being said, that's separate from they now have this information at IRS and they're going to be looking for it or asking questions. You cannot just summarily dismiss it if it got wrong for any number of reasons. There are corrective steps which include or but not limited to asking for an amended third-party platform 1099 or putting it on your return and backing it off with an explanation code. But regardless of that, if you get one, the IRS got it, and you cannot ignore it. Even in your heart, if you know it's not taxable, you're going to have to take actions. Ignore it, you're going to get a letter this summer.
Let's clarify. Let's just say I sold Taylor Swift tickets for $5,500. I'm automatically, with one Venmo, I'm already over the limit. Am I taxed on $5,500 or am I taxed on $500?
Great question. Susan, doing it herself, will put down the $5,500 because she'll get it wrong doing it herself. Your guy will know that it's only the gain that's taxable, the difference between the gross proceeds and your basis or what you paid for it. So it's only the gain that's technically taxable, but you can put anything you want on your tax return and they're not going to check it for you. They're going to keep that money. So it's incredibly important that you know what the rules are and do not put too much on there. It's also important that you don't ignore it because you don't think it's a taxable gain because it was personal when I sold those tickets to my cousin. That's not the rule. The rule is if you have gain, it's taxable. Gain is the difference between what you got and what your basis is, and that's an important differentiation.
How many people are going to make that mistake this year? Because this is brand new. This is right out of the gate with a tier level, kind of dipping your toe in. It goes from 5,000. Next year, you said, Mark, it's going to be 2,500, and in the third year, it's going to be 600. Anything over 600, you're going to get taxed on. That is, and the reason obviously is because Uncle Sam wants bigger hands in your pockets. It wants more money.
And that's an important point, but the important thing for your audience to know is this. This is not a new rule. You've always had to report income and gain. So there's not been some, money grab by the IRS. This goes back to 1913, 117 years ago. If you've got income, it's taxable. That rule didn't change. What did change is the IRS is aware of a lot of people getting paid who might misunderstand the rule, might take some advantage of not knowing the IRS doesn't have this information, or they may just be trying to cheat. Regardless of the reason you left it off, it's always supposed to have been there.
All right, let's move on. What else do we need to know about that is something new that we were not aware of last tax season?
Well, bigger than the 1099K and bigger than other statutory changes are the biggest single element on your tax return, your life changes. They drive a lot more tax complexity, tax benefit, tax risk, and those have not gone away again since the dawn of taxes. If you're getting married, getting a divorce, had a child, adopted a child, fostered a child, those are kind of obvious. But what we've seen since the pandemic, there are more and more diverse types of life changes. Side hustles being a big one with near 40 million people who had to do it to make ends meet back in the pandemic time, but now they've found that they enjoy it or they like the cash or maybe they don't think it's taxable because it's side hustle income and there's no reporting. The regardless fact is if you've got family or personal or other life changes, including taking care of dependent parents, kids going to college or yourself continuing an education, trading in cryptocurrencies big right now, you probably have something that needs to be on your tax return, both federal and or state if you're in a state taxable rule, and there are a lot more state changes than we'll go into. But the point is this, life changes, a lot less common. We're not talking about those as much, but they're there year in and year out for all Americans, and you leave them off by doing it yourself at your own peril, because if you left off taking care of a dependent parent and you left off the other dependent credit or you left off the medical that you can take because they are your dependent now that you're caring for them, the IRS is not going to add that money back. You're not going to get a bigger refund because they just don't know, but you got that tax return done, you did it real fast at midnight on the 15th, you did it yourself, you answered a few questions, you left off that cash, it stays off.
Oh boy.
I mean, that doesn't sound fun. I want all the money I can. How do we actually maximize getting money back, though? If you are a person, there are a lot of people who the standard deduction absolutely makes the most sense. They don't have a complicated tax situation.
Well, that is entirely true. In fact, a lot more since the Tax Cuts and Job Act, or the Trump cuts back in 17. That expires in 11 months and about 8 days. That's gone. So you're going to go back to the old standard deduction rules for 2026. That being said, I see that story a lot, and I see people who say, yeah, my house note is low, my interest rate's low. I see retirees who say, I don't even have a house, but I had huge amounts of medical. So we see a lot of people taking the shortcut, taking the standard deduction. It's fast, it's easy, it's expedient, and they leave off the ability to itemize even though they had more, and they cost themselves money. We see that as an overlooked benefit tens of thousands of times a year because it's just fast and easy, and people prefer that over more money. That being said, as I said, 2025 is going to be the last year of those tax cuts. 26, depending on how some of the legislative activity happens, an enormous year of change, and we haven't even gotten into cryptocurrency and the new 2025 1099 DA for digital assets. No more hiding that either. That's now going to be in the man's hand next January 2026. They will know your digital asset trades.
Two questions. First of all, the deductions, the standard deduction is increasing for this filing. It's going to what?
Well, it depends on your filing status, whether you're single, whether you're married, filing joint, or head of household. It's in the 15 range if you're single, 28 if you're married. I don't have the numbers right here in front of me. They're on the form. It's still a huge number. She's not wrong.
Right.
But you'd be surprised how many people have a mortgage interest, and then what they forget is they have charitable donations, cash or non-cash. They have taxes, property taxes, state income taxes, sales taxes. They have medical. They may have some other items in there as well. And they leave all that off at their own peril because they could have got a bigger deduction. Maybe not a huge bigger deduction, say another $4,000 or $5,000, but at a 30% tax rate, that's $1,500 cash.
Yeah, but it is difficult though and challenging to get over. I think the last one I saw it was like $29,000 for a married couple filing together jointly, and I think it was 29,000. Way back in the day, you would have to, I don't know what the standard deduction was then, but it was very, very low. But once you threw in your property insurance, real estate taxes, everything, it was easy to kind of get over that standard deduction. But it's really challenging now to come up with enough stuff to get up and over the $29,000 example. But you're saying, there are some things out there, if you look closely, it might push you over.
Oh, absolutely. You got to have an extreme case, but that all goes away at the end of this year. Let's be clear. That's 2025. That big standard deduction stops, depending on how our legislators.
All right. So what's it going to be going down to?
Back to half of what it was back in the pre-Tax Cut and Job Act. But that being said, that's only the standard deduction, itemized deductions. There's over a dozen tax credits, including green credits, home improvement credits, child tax credit, earned income credit, other dependent credit, education credits. Those are not part of that, equation.
Right.
They're separate, and you can leave those off just as fast because you don't think they apply to you.
Really fast. I know our time is ticking away, but talk me through medical deductions, because I think a lot of people don't realize what is deductible when it comes to medical expenses.
Yeah, it's a lot like the casualty loss, which is probably another whole topic given the nature of the disasters we've had this year, from fire to flood to snow to the rest. The medical deduction has been changed for about the last 15 years. You really have to have an extreme medical situation to both take the deduction or to qualify. I'll start off by saying it's only your out-of-pocket amounts. You only get to take the monies that are not covered by insurance and are not covered. Second haircut, you have to take 7.5% of your adjusted gross income off the top. And then only if you itemize. So to your point, that's not many people. But where it does apply, medical catastrophe, heart, cancer, any of those things for uninsured, it can be a game changer in terms of the tax deduction, much like your casualty disaster. You can't deduct the loss of your boat or your car. But if you've had a catastrophic loss in a federal disaster area, do not look past the disaster deductions or the medical deductions, and that's another good reason to have a tax pro. It does not apply to everybody. Call it a 2 or 3% rule. But if it's you, it's tens of thousands of dollars at perhaps your worst time in the world, and it's often overlooked. So if you've got medical, and by medical, I don't mean buy an aspirin. I mean, you'll know it if you have it. Talk to a pro. If you've had a disaster, I don't mean your mailbox got blown over. I mean, you really suffered some economic loss. There's some really nice, juicy rules in the tax code that are yours, and you deserve to take them. But don't overlook them doing it yourself at midnight on the 15th.
Mark, I know you're up in New York, so you may not be familiar or too familiar with Arizona, but our listeners should know that we don't have that 7.5% rule here in Arizona. So everything is deductible medical wise. So I think our listeners need to know that.
Well, and I'll simply say your state return used to be just a non-consequential, small, de minimis amount in all states, all the 43 states.
Yeah.
States now have kind of taken on their own, and there's all sorts of credits, there's all sorts of benefits, there's all sorts of zero deductible thresholds that apply on the federal. So when you're using a pro, and my goodness, if you're doing it yourself, make sure you understand those rules so they make more sense for you on that state return than any other reason to hire a pro, because you got some special consideration that you didn't have when you lived in Texas or Florida. But now you've moved to a taxable state, Alabama or wherever, you might have a nice benefit that you didn't have before, that you didn't know about, and you did it yourself fast and dirty and left that off. So
Mark,
states, that's real money now.
Yeah, it is. And we really appreciate you being on the On Your Side podcast. If people want to know more about Jackson Hewitt or Mark Steber, where do they go to find answers?
Website, jacksonhewitt.com. We have videos. We have frequently asked questions. We have all the cool calculator toys and tools. And you can set up an appointment or just get a location and walk right on in and get that tax return done in about an hour. It's a smart way to go. If not this year, every other so often, don't throw all your tax knowledge to risk going to, TikTok and Instagram on your knowledge or Uncle Bob. Get some help. Get the free review during the summer. It's a smart investment on your single largest financial transaction, your tax return for 30, 40, or 50 years.
We appreciate it. You enjoy the rest of your day, and thanks for all the help, okay?
Great to chat with you guys. Talk to you later in the season or next year for sure.
The On Your Side podcast is produced by Brad Denny. Our audio engineer and editor is Todd Martin. Segment producer is Colin Stanton. And I'm Gary Harper.
And I'm Susan Campbell. If you have a problem you can't resolve, maybe we can't, send us a message through azfamily.com or our AZ Family mobile app. Look for the On Your Side section and leave us a message. Thanks so much for listening to the On Your Side podcast. And if you like it, leave us a review. We'll see you next week.
On Your Side is on Good Morning Arizona every weekday morning at 6:45 and 7 o'clock, and every weekday evening on Good Evening Arizona at 4 and 5 o'clock. You can also catch it on Arizona's Family News at 9 on 3TV every weeknight.